Hi, it's Larry Gaines from Options on the Open. We are the leaders in day trading and swing trading using options, and it's our goal to teach all of our members how to consistently make greater returns each and every day using options to trade. In this short video, I wanted just to touch on weekly options. The weekly options have been out for a while, for over a year now, and they are commonly called weeklies. They come out each Thursday, and they will expire the following Friday. Now, the beauty of weekly options is that their time frame is a very short duration, which can be 1 week or even 1 day if you're trading. And so they provide a very low cost capital structure way to enter an option and to make fantastic to incredible returns in just 1 day. Now, at Options on the Open, every Friday when a weekly option expires, we will look for various weekly option trades. And basically, to understand what a weekly option is that just to understand the option itself. Option value is just made up of time value times the implied volatility of the option times its intrinsic or extrinsic value. So the beauty of a weekly option is that as you get closer and closer to the Friday of expiration, your time value goes to zero. So they're a very low cost way to trade for either an upside move or a downside move. And so you can totally define your risk involved in the option, and you can take a trade for some tremendous high returns. So I won't go into strategies in this particular session, but if you'd like to learn more about weekly options and how we trade them, please join us at Options on the Open. But this particular trade we did this past Friday, and it was on Amazon, and this was on Friday, October the 28th, and at the start of the day, at the opening of the day, the broad markets measured by the S&P 500 and the Russell and the various other broad index markets were basically trading sideways. So to find a good weekly option, a lot of times you're looking for relative strength or weakness in a particular stock or ETF versus the broad markets. And for example, on Friday, Amazon opened up down here at about 205.69, and it started immediately trading higher, whereas the broad markets were going sideways. So the weekly option on Amazon at that point in time, like the first 10-15 minutes during the morning, you could have bought the 215 strike, which expired that day, Friday, October 28th. They were selling at that time for 10 cents. 10 cents per contract, which is, if you bought one contract, that's $10. So you could buy one contract, or you could buy 100, or you could buy 1,000 contracts, and it would cost you, $10 per contract. So let's say you bought 10 contracts, and you paid 10 cents. So your cost of controlling those contracts was $100. So for 10 contracts, your maximum you could lose would be $100. Now, as this particular stock, the underlying stock of Amazon, started moving higher, the options immediately started moving higher as well. Now, I bought the Amazon 215 strikes calls that morning, around this time frame, and I paid 10 cents or $10 per contract. About 10 to 15 minutes later, as this market was moving up, I immediately sold out of these contracts for $50 a contract. So that was, to me, I was like amazing fast return, and that was over just a matter of 5 to 10 minutes. I was able to make, just over that 5 to 10 minute period of time, I was able to make a 400% return on those options that I paid 10 cents or $10 per contract for. So just figure the math. Pay $10 for one contract, sell it at $50. That's a $40 per contract return divided by your cost of capital, $10. So $400. Now I thought that was a fantastic return. I was happy with it. But at the end of the day, this stock, Amazon, went over $215. So they pushed it and pinned it above the 215 strike. Now when this happened, the option, which I had bought earlier in the day for 10 cents or $10 per contract, was trading that this spike right here, this contract was trading for over $3.50. So that is $350 right here for one contract. So it went from $10 to $350 in one day for one contract. Now figure the math on that. That's over a 3,000% return. So for something that you could, the max that you could lose that day would be $10 for one contract, or if you did 10, that's $100. If you'd held to expiration to this period of time right here, you would have made, for that one contract, you would have made over $340. So that's the beauty and the power of weekly options. So please come join us at Options on the Open. That's optionsontheopen.com, and good luck trading. Good luck trading this next week.